welcome to a new episode of the Boopos Buzz. Today we are interviewing Alex and Pavel Prokofiev. You guys are obviously siblings, right? Brothers.
Correct.
So you've known each other for a very long time, I guess. And it's great to have you here. I would love to hear a little bit more about your background. Obviously, you've run parallel careers and you work together in some stuff and then separate in others. And I would love to hear more about what you've done, and perhaps our audience would like to hear where you come from.
Yeah. Well, firstly, we're really excited to be here. I think we're very excited about Rollups, and we're very excited about what you guys are doing with Boopos. I think it's probably more appropriate if Pavel kicks off because he's been in the serial acquire space for far longer than I have, and indeed has been an inspiration for me to join it. So maybe Pavel, over to you.
Sure. Again, great to be here, Juan. So I've been in finance and M&A for now about 13 years. Started with KPMG a while ago, qualified as a chartered accountant before moving on to two private equity jobs, first focusing on emerging markets and then investing predominantly pre-IPO situations in North American companies. And after about 6-7 years, I realized that I wanted to become an operator, and that kind of led me soul searching for opportunities in the corporate market. And pure by some luck, I ended up joining Constellation, which, it was one of those situations where, you don't know anything about the business, but the more you read the Mark Leonard letters, looking at the share price, you really become heavily invested with the business model. So I spent 2 years there, learned the ropes, closed a couple of exciting transactions, and then made my way into SaaS Group, where I have been the head of M&A for the last 3 years, deploying capital into PLG self-service software companies globally. So it's been five years now in the software roll-up industry. Super excited about where it's coming, and obviously working with Alex now on Rollup Europe.
Yeah, it's interesting that I have a somewhat similar career as Pavel. So I'd spent most of my career working as an investment banker. So buying, selling businesses, raising capital, all the usual stuff. I then shifted over to corporate development. So I worked at corporate development at a bank, worked for a tech company, but I kind of felt unfulfilled, because when I was working in a bank, I felt like I was always not the main actor. I was always the intermediary. I wasn't really the principal. When I was working for a tech company, I just felt like being in the finance team, being in the corporate development was never that important for that particular tech company. So I had this moment of soul searching around about 3 years ago, and I sat down with Pavel, and he started telling me about serial acquires, and I was like, I don't know if I want to be buying those like 3 million revenue businesses. What are you talking about? And then Pavel showed me the map, showed me the famous Constellation software case study, and I realized like this is the opportunity I've been looking for my entire life. And it's a good thing that I saw it today as opposed to maybe 20 years out when I'd be a bit older than that. So I ended up joining a business called Three Codes, which is a very similar concept to SaaS Group, but much more narrow. So an acquirer of e-commerce SaaS businesses. I joined it as the head of M&A and group CFO. And at some point, we set up Rollup Europe, and then about a year ago, I left Three Codes to basically build my own holdco.
Good. Thank you, guys. I think if I were to summarize what you both said, you're very experienced in M&A, and I think you have the same realization at some point in time in your career as me, which is being an investment banker and an M&A professional is exciting, but sometimes it makes more sense, or it's even funnier to work on those M&A transactions for yourself and becoming an operator at some point in time. Okay, I think, to me, the objective for today's discussion is to learn more about, obviously, the roll-up industry in general, and we can chat about that. But I would love to hear about Rollup Europe and how it helps people who are, running roll-ups and want to build roll-ups. What is Rollup Europe? Why don't you just give me the 2-minute pitch?
Paul, do you want to go first?
Sure. Well, Juan, I think I want to give you a bit of a backstory how it all started, and I think that pretty much summarizes the pitch. When I joined SaaS Group, we've grown about 4 or 5x in the last 3 years, and when I joined there, I had to think about such things as valuation of SaaS companies, cost cutting, value creation, tech DD. So there are a lot of questions that you have as a head of M&A, but there's no one to discuss those issues, right? And I went a couple events in London. I met some operators, but none of them had the same experience as me. And so me and Alex came up with this idea that why don't we create kind of a Slack channel or a medium for people to essentially meet up and discuss serial acquisitions. And that's how it all started, essentially out of frustration that there was not a conference, there was not a blog or a place where we can just meet people that are just like us, buying companies, doing tech DD, FDD, negotiating APAs, SPAs, kind of cross-border deals, right? And essentially the very first event that we did was to bring together people doing that and just talking, right? How do you source deals? How do you raise capital? How do you value targets, right? And 1 year later, we are basically the Europe's largest gathering, largest community of serial acquirers, whether it's private equity or buy and build, buy and hold, various platforms, as well as debt equity providers. And we also have, a blog that essentially is the voice of the industry. So to summarize, it really came from the bottom, right? Out of frustration that there was no way, no medium for us to exchange ideas, to then realizing that the industry was changing. There were a lot more software aggregators being launched, and actually most recently, not just software, but also accountancy, B2B services. And essentially, we're seeing that Europe is now approaching an inflection point where we're starting to look a lot more like US, where people have been doing kind of the boring, the Cody Sanchez boring holdcos of HVAC contractors. We're seeing that catching up. And so we basically managed to come in at the right time and become the media provider and the platform for people that are, buying and selling companies.
Interesting, and definitely much needed, because I think it's a space that's growing, but at the same time, sometimes when you get into it, it sometimes feels that you're quite alone and you don't know where to go. So I think definitely much needed, perhaps a pain that you experienced personally. So that's why you created this. One question that I had though, what's the typical, what are the people who are part of this community? What's the crowd? Because I'm thinking of serial acquirers, and that could be Constellation type companies or teams that are looking to buy vertical software or independent businesses and have the owners run them by themselves. Then you have all these more like three calls, right? That they have a thesis around e-commerce enablement, and then perhaps they seek synergies among the different software pieces that they're acquiring. What's the typical, and also in terms of stage, right? I think obviously when you're starting a Rollup company, it's much harder to there's a learning curve ahead. But once you've moved into, acquiring your first 4 or 5 acquisitions, you've somehow mastered at least those initial steps, and the pains begin to be slightly different. What's your crowd, and who are you catering to in terms of industries, profiles, verticals, strategies, sizes?
Yeah, I can take that. So we started out by catering to software serial acquirers, because at the time, and for Pavel still is the case, we were in that industry, so obviously we have a lot of credibility. We also understand the industry, the needs. For me, frankly, the kind of short-term impulse to do this, I was just fed up of going to generic conferences. I think this is one particular issue in Europe, is not only do we have investors who on average are less perceptive and less open to new ideas than the US, but also the conferences in Europe are just much more generic, right? Like when you go to SaaStr versus like European SaaS conference, you just don't get the same amount of data. And I think if you read our blog, if you come to our events, there's a lot of hard data that's actually being shared, which makes me very happy. So you're absolutely right, Juan. We started out with software in mind. Today, probably still the kind of like the bedrock of Rollup Europe is technology serial acquirers. Not just software. We also, in our database, which has over 300 entries, we track, serial acquirers of web hosting, of YouTube channels, of apps. But it's grown now much more than that, right? So we have a conference in less than a month in London, which is a UK Serial Acquire Summit. And there we'll have software businesses, but we'll also have businesses that are buying niche manufacturing businesses, right? So I would say that for us, the most important audience, the one that we're really trying to reach every day is, holdco builders, right? So people like Pavel, anybody who basically wakes up tomorrow and says, listen, I want to start buying businesses because I think I can generate value, right? So whether or not you're working for a private equity owned business or you're just trying to do it with your own money, it doesn't really matter to us, right? As long as you come with good intentions and you're interested in learning about this industry, you're very interesting to us. I would say that the kind of second most important kind of demographic or target group would be the investors. So increasingly, we see more and more family offices are realizing that this industry is a very interesting asset class. It's effectively comparable in terms of risk return to maybe private credit or private equity, but it's very hard to get exposure to, right? So there are very few vehicles, and certainly no listed vehicles that would offer this type of exposure. So we're continuously trying to educate family offices, private equity firms, lenders. We educate a lot of lenders, brokers, basically all the people that could fund the very first group. And then obviously, on the periphery, you've got lots of intermediaries, you've got marketplaces, you've got lawyers, recruiters, et cetera, et cetera. But again, if we have the first two categories locked down and these people are engaged, then obviously everyone else is very happy to show up.
Mm-hmm. Interesting. By the way, I had a few questions here that might make you give interesting tips to people who are starting roll-up companies. And one of them was related to funding. I think this is somehow not very transparent market. I mean, I'm starting my own business, and I know that I have to raise money from VCs, and then I can go there and I know that channel pretty well. I know that if I work at a private equity firm, I can buy businesses and use banks for leveraging them. So it feels that once you get into that, it's pretty transparent. But who's funding roll-up companies and aggregators? I think it's kind of trickier, right? Is it family offices? Is it private equity firms? Who do you have to engage with? Because I feel that sometimes it's something that you're starting from scratch, right? Because you're acquiring a few targets from scratch, you're building a team and so on. So it feels like a management buy-in. But at the same time, it's also somehow high growth, right? Because you have a plan of rolling up several companies over time. What type of investors should you seek when you raise funds for aggregating?
I think Pavel should take this because that very topic was, I think, the very first article that we published in our blog. Like, who is the patient capital that's actually funding roll-ups?
Okay. Well, maybe if I simplify Juan's question a little bit, let's just talk about software for now, right? Because there are other business models like fire and safety in the UK, which is mostly private equity backed. So if you just take purely software, I would say the answer to your question is that all of those people, right? You see VCs typically funding ecosystem or industry-specific themes, and good example would be e-commerce. Guys like Three Calls, Stay Tuned, Jungle Scout, that mostly play in that Amazon, Walmart, and similar ecosystems. Appfire, UpHub would also be very good examples. Then you have private equity. Private equity tends to be what we call captive aggregators, where private equity starts an aggregator from scratch. And good example would be what Aquiline Capital Partners have been doing with Full Steam, Clear Course, Everfield most recently. PSG has had Tiugo and a bunch of others. So these are the two main categories. And then you also have family offices and kind of, we call them patient capital providers. And there you would have businesses like Uplift, I think, that have been funded by Sater Grove Capital, former Notre Dame endowment investment team, and niche place like Forum Family Office out of Germany that do kind of the VMS strategy. So we really see all of those players playing in the market. There are some interesting questions because we sometimes don't necessarily agree that software rollups is the right asset class for VCs, but nevertheless, we are seeing VCs again and again providing money to to different rollups. I mean, Cherry Capital recently put the money into rollup, and we've seen I think Unaric and Ascendex also attracting money from VCs. So everyone is there, but typically for VCs, it's an industry-specific theme. For more of a general aggregator like Banyan, Valsoft, Constellation type of guys, you would see mostly permanent capital slash family office type of funder.
I guess I think it Yeah, it depends on the type of strategy that you're carrying out, right? So that makes sense. Then another question that I have was related to the team composition, and I'm asking this because I have quite a few friends that come from M&A backgrounds, and so they see that obviously this space is hot now, and there's interest, and there's a lot to be done and a lot to be built, and they jump directly into the space. They parachute, right? They land there and they try to buy companies. And my tip for them is generally you should hire a CTO or find a CTO type of co-founder or technical co-founder. Otherwise, it's going to be really hard for you to run the businesses. But perhaps that tip is not useful for everybody. What have you seen in terms of building, assembling a team for being successful in rolling up?
Maybe I'll start. Yeah, Juan, it's a good suggestion that you need a CTO because you're buying kind of software assets. I would say that based on what I've seen so far, and Alex can elaborate, the biggest challenge with Rollup is raising money rather than buying something, right? Because the market is big. It's not that hard to find an asset. And so I think a lot of people are rather finding a co-founder that's kind of a long-standing operator that has a lot of connections, that knows how to drive the value. And those tend to be more salesy type of people, right? Because you want to, if you're not coming from kind of a private equity background where you have a lot of friends that willing to write a check, you need to have that person kind of as a senior partner. So not necessarily a CTO, but someone that can participate in a pitch with you and convince investors that whatever enterprise company you buy, that person can go in and fix the go-to-market, do a price increase and things like that. Because for CTO, you can always get somebody on a fractional basis, or use someone like tech miners to do a tech DD at a fraction of the cost. So I would say that find someone that really knows the value drivers of a software company and can help you both do the fundraising as well as doing the actual, fixing the business after you buy them, because the first couple acquisitions that you do, they really have to work out in order for you to then do the debt financing and do a next equity round.
I would maybe extend what Pavel has said, and obviously the caveat here's you have two finance guys. Obviously, we're not going to advocate that you should have the CTO as the CEO of the business. So we're a little bit biased. I would maybe extend and summarize what Pavel has said. Ultimately, you need two things, right? One is that you need to get this thing funded, which is you need somebody with a great network. And I think if you look at the sort of aggregators that have raised money over the last 24 months, overwhelmingly, the successful firms have been led by ex-private equity people, right? Because private equity partners people are very wealthy. They understand the model. And for them, it's not a problem to write like a 7, or even like an 8-figure ticket. I think trying to raise from VCs is a waste of time. VCs have backed this space that they've invested, but ultimately VCs don't get this. And, your probability of raising from VCs is just much lower versus maybe targeting some high net worth individuals with experience of private equity. So I would agree with Pavel that you essentially have two core skill sets to get a software aggregators off the ground. The first one, get debt and equity. So you need somebody who's credible. You need somebody who can put together a credible business plan. And you also need somebody who can develop a sort of a good pipeline of deals and talk sort of the ROIC language, because ultimately it's a ROIC game. The second thing is oftentimes you're buying businesses that haven't grown for a reason, right? A lot of people now talk about buying fallen angels and VC-backed investments, and maybe this is happening, and I think a few firms are looking at that. But your bread and butter companies between 2 and 10 million in revenues, they're not growing very fast, and sometimes they are not working. And more often than not, it's not a problem of product market fit, because a company cannot go on for 15 years and not have product market fit. It's a problem of maybe it's mispriced, right? So prices are too low. Or maybe the problem is they don't have a go-to-market. And as Pavel said, you need to have somebody with a bit of a sales understanding. So somebody who can come in and say, hey, is this product positioned in the right way? So I think once you got it off the ground, once you've raised the money, once you've done the first couple of deals, the next step to figure out is what level of centralization do you actually want to have? When we had a series of articles about that, where we looked at, hey, do you want to have a centralized holdco where basically everything is at the HQ level, everything is integrated? Or do you want to take the other extreme where everything is decentralized? You're literally running an ultra lean holdco with maybe 3 FTE. And I think depending on which one of those, maybe it's something in the middle, then you can also decide who should sit in the leadership team.
Mm-hmm. Yeah, makes sense. Now that you mentioned about revenue management, I think that's also part of the core Constellation software playbook, right? Taking a look at the revenues and all that. There's a lot of value to be unlocked there. Also, now that you mentioned in terms of deal size, right, and business size, I've seen like micro aggregators acquiring businesses that are making like 500,000, 300K. I sometimes feel that perhaps they're investing a lot of time and effort in something that is going to be really hard to scale. And I'm talking about the number of acquisitions that you make to get to significant revenue, but at the same time, also scaling each of the different brands or products that you're acquiring. What do you think? Obviously, the barriers to entry are much lower, right? You need to raise less capital for that. And so that's perhaps one of the reasons why people go into these micro software tools that need to be managed perhaps in a more centralized way, right? In the end, they don't generate enough cash. But perhaps there are advantages to that. What do you think about buying like very small assets versus huge assets that perhaps you don't have the capital to do?
Yeah, Juan, to be honest, you're right. There's a huge micro SaaS movement, and I would differentiate kind of micro SaaS. We're talking MRR that's like 5, 10, maybe 100K, right? So less than $1 million in AR on average. And you have a lot of influencers that built in public, a couple really cool guys on LinkedIn doing that on Twitter. So for me, this is a very different business, right? When you buy a 300K AR business, you really can't hire a team behind it unless you're hiring like an ultra low cost jurisdiction, right? And if you want to have a product manager, marketing person, support, developers, right? You need at least couple million AR to start with, right? And so guys that do these smaller acquisitions, they're hoping that they can, through growth hacking, go from 10K MRR to maybe 50K. So 5x. It's easier to go from 10 to 50 than to go from, 2 million AR to 10 million AR generally, right? If you know what you're doing. And so for me, this is quite a different market. And usually the game there is not to build a holdco, but try to grow them as fast as possible and then sell them through, acquire.com, Flipper, or a business like that. So I really don't see a way to build holdco out of a 500,000 businesses, right? Because you would have to fractionalize pretty much everything, right? Unless because it's hard to have just one developer working, and even if one developer works on them, it's quite a big salary, and that's already a big chunk of your EBITDA. So for holdco, I would say that you need, on average, minimum AR of maybe $1.5, ideally $3-4 million, and because then you can start hiring very good people. You could start fractionalizing CMOs, CTOs, like people that are even more expensive, have 10, 15 years of experience, and kind of apply those best practices. And this is where a lot of bigger aggregators go. The micro SaaS for me is just kind of a really buy something cheap, do some growth hacking, SEO, Google Ads, do a few UX changes, and then sell it for 2-3x, and then kind of reinvest the cash for the next deal.
Exactly. I feel like those are exactly the trading type of businesses. We have a lot of respect for people who are good at that. We interviewed Mushfiq Sarkar a couple of months ago. I mean, he's bought and sold like probably over 100 businesses. And I think when you talk to this guy, like within 30 seconds of the conversation, you understand that like he knows how to nail SEO, right? He knows how to nail backlinks. Like he's got this catalog of super good people for anything you could possibly want. And I think more often than not, those people develop a sort of a specialism in one specific area. Let's say they're really good with WordPress, or they're really good with marketplace or something like that. I think to be able to scale like a larger business from those micro acquisitions, I've not seen that, because I think the skills that you need to build a larger organization are very different. They're kind of very complex, but also I feel like the survival rate of those larger companies is much higher. And so maybe when you building a company like SaaS Group, what we did in 3 calls, a lot what we were doing was not necessarily like trying to salvage a business which declined 90%, which happens to those micro companies, but more like HR decisions, right? Like, okay, so the founder is going to leave. Who do we put as the new GM, right? Or how much do we centralize? But yeah, I think if you're starting out like that, I agree with Pavel that building in public is not a bad idea, because worst comes to worst, you can build like like a media business like Michael Girdley. You can have a lot of followers who basically pay to watch you code or kind of fix SEO.
Yeah, makes sense. I guess it's good for hustlers, right? People who are solopreneurs that want to make money, but they don't want to build a big team. Sometimes big teams are hard to manage, and obviously it's a completely different skill set. But yeah, it makes a lot of sense. I wanted to touch. I mean, before we were getting to the end of our half an hour chat, but before I let you go, I wanted to chat a little bit about what you're seeing, and this is a topic of interest for both buyers and sellers. What you're seeing in the market in terms of multiples, and why do you think businesses would deserve a higher or a lower multiple, and what are the key attributes that buyers are looking to value a business at? 4x, 3x, 5x, and whether those multiples should apply to revenue or EBITDA or even cash. Who wants to take that one? Alex?
I think Pavel's in the market, so he should start.
How's the man? Okay. I don't want to, maybe I don't want to compromise your role as a SaaS buyer, but whatever you can share, it would be greatly appreciated.
So I think the answer to your question depends on what type of buyer you are, right? So if you are a private equity or a strategic or a standalone aggregator, they're all different considerations that fit into valuation multiple. Private equity tends to play on a larger end of the market, 7, 10, 15 million AR, where due to the need to deploy capital and generate returns, and due to bias to buying growing companies, that tends to be much higher multiples than, say, on a 2 to 5 million AR type of businesses. And I would say that the smaller is the business, the higher the risk, and therefore you tend to see lower AR multiples for smaller businesses. And maybe in between the private equity and kind of those aggregators, you also have strategics that very often they raise money at 6-7 times AR, and they're kind of buying at half the price, which is 3-4, and they're not necessarily looking at EBITDA multiples. For a vast majority of the market, I would still say that EBITDA is the king, right? People are looking to buy profit. If you are building a holding company, it's funded by debt and equity. I need to be able to pay your operating costs, to pay your debt cost, and therefore buyers really need to make profit. And hence, there's a lot of focus on buying companies that can achieve a sustainable, profitable growth. So not the companies that are growing 30% AR with zero EBITDA, but companies that are growing 30% with 20, 30, 40, and 50% EBITDA margins, right? And then you pretty much use EBITDA for valuation, and your EBITDA multiple depends on on couple drivers. One of them is how fast are you growing, right? So whether you're flat, shrinking, or you're growing 10, 15, 20%. And secondly, the quality of your growth. And the quality of your growth is really a factor of two things. One of them is net dollar retention and your new MRR, right? So is your new MRR increasing every year? Is it decreasing? Is it flat? And secondly, how stable are your customers? Are you concentrated, right? So you could be growing 50% year over year, have a very high EBITDA margin, but if your net dollar retention is like only 50%, right? That is not the same as having net dollar retention of 95% and growing 50%, right? So you take all these things into consideration, and obviously the highest multiples are the companies that have growth that is unconcentrated, where the new MRR is growing year over year, where the net dollar retention is around 100%, where you don't have any customer concentration, and you also generate a lot of free cash flow. This is where kind of you get the highest price, and then you get the lowest price if you are growing without any profit, with heavy customer concentration, and where in the buyer's view, there's a lot of heavy lifting that needs to happen in order to make a decent return.
Interesting. You've cut a little, but I think we can make some edits and make it work.
Yeah, I wanna actually add on top of Pavel, because I think Pavel offered a very kind of micro perspective, which I think is super useful. I think if you kind of zoom out in terms of how people derive those multiples, it's either MOIC based or it's ROIC based. Okay, so if you're a private equity firm, so we did this write up a few weeks ago where we looked at the multiples at which private equity backed serial acquirers in the software and tech space have exited, and typically they've exited at between 4 and 8 times revenue. It's a very broad range, but essentially translates into something like 15 to 20 times EBITDA, roughly, right? And so if you're backed by a brand name private equity firm like KKR or Partners Group or Blackstone, or HD Capital for that matter, you're able to raise, anywhere between 4 and 8 times EBITDA in terms of debt. So if you then do the math, if you work out, how much can you raise in debt and what multiple you can exit, then you plug in what MOIC do you need. So let's say, you're targeting 3 to 5x over 5 years, and that allows you to calculate how much you can pay per acquisition. And then you can factor in synergies and what have you. So if there is a private equity in the process, because for them, there are some synergy savings, because there's the multiple arbitrage, because there's much better access to debt than any of the standalone holdcos, they're able to pay substantially more. So rule number one, do not bid for assets that private equity is also looking for. They can easily outbid you. They can easily pay 10, 12, even 15 times EBITDA. I think for more permanent capital acquirers, MOIC is not that relevant because there isn't a liquidity event. I mean, sure, they may end up listing and they may end up raising more capital, but for them, they need to be able to compound cash flows at a certain rate. And if you look at how most of these firms they would look at something like return on invested capital, plus they would look at organic growth. And so that typically should be in excess of 20%. Okay, so your ROIC should be higher than your weighted average cost of capital, and your organic growth ideally should be not zero. And so for them, it becomes an equation where, okay, this is the amount of capital that I'm putting to work, irrespective of whether or not this is debt or equity. And so at every single asset, I should be generating a ROIC plus organic growth of more than X. And that's how they price it, right? So then you factor in a bit of growth, you factor in a bit of margin improvements. And if you're lucky, you're able to bid maybe, 10 times EBITDA. If you're not lucky, maybe you bid 5 times EBITDA. If you're feeling very optimistic and you think the business can be turned around, maybe you bid 15 times EBITDA. But I think ultimately you derive the multiple by combining those different frameworks, and it's very difficult to give a very generic answer if you don't have all the detail that Pavel mentioned.
Interesting. Thank you, Alex. By the way, when I learned about Constellation and all these companies that are planning just to hold forever, I was it struck me, right? Because I come from a private equity background in which you have your 5-year plan and you need to plan for an exit at a certain multiple. So it was like, wow, these people are holding forever. Impressive. But yeah, I think we're done for the day. Maybe you have any closing remarks that you want to tell our audience, other than obviously everybody should join Rollup Europe because that's a very valuable community for the Rollup aggregator space and the people who are working on acquiring software.
I think there's a generational opportunity in Europe to transfer wealth, capital from retiring business owners to holdco builders. I think Europe in many ways is doomed. Demographics here are bad, economy is bad, energy is bad, like everything in Europe is bad right now. This is one way to think about it. But on the other hand, because Europe is so inefficient, because we've got so many businesses, digital and brick and mortar, that are very inefficient, there is an opportunity to basically buy those businesses at low multiples and build them into something big. And I think if you are in your 20s and 30s and even 40s, if you're done with your corporate career, if you're done with your VC career, if you're done with your investment banking career, you should just go and work for a holdco. You can work for a serial acquirer like SAS Group. You can join a private equity backed. It doesn't really matter. But I think this idea that serial acquirers is a strategy that works at plus 5% GDP growth. It works at minus 5% GDP growth. And so your fastest and most risk-free way of generating generational wealth today in Europe is through this type of strategy. There's nothing else that works. And I encourage as many people as possible, as you said, Juan, to read our blog, come to our events and join this industry, because that will be very intellectually and financially rewarding endeavor.
I couldn't agree more. All right. Well, thank you, guys. Pavel, anything else that you want to add?
No, I just want to say I totally agree with Alex. I mean, for those that are not ready to start a roll-up, join one, learn how to do it, learn how to create value, how to buy companies, how to build a pipeline. I think it's an exciting market to be in. So we would encourage as many people as possible to come to our events, read our newsletter, ask us questions, and ultimately engage with the community, because it's so rewarding for us to get emails from people these days saying that, hey, I've been to your event and now I got a job at this new Rollup, and I'm super excited. I got my equity, I got what I wanted, and so it's super rewarding. And we're hoping to see more and more stories like that and make this industry a really big success in Europe.
Agree. All right. Well, thank you guys. This is all for today. Have a good day.